Yes, just like I was saying, this is the second last class that we're going to have. And tomorrow we are going to have module 30, and that will be our last class. We'll close it off by looking at careers in the crypto, Web3, and the blockchain ecosystem. So let's start. In this class, we're going to master the mental game, or rather what we call risk and psychology, or rather emotions and psychology in trading. And under this, we're going to look at, or rather we're going to understand and implement effective risk management strategies, then identify and control emotional traps in trading, build a resilient and disciplined trading mindset, use trading psychology tools like journaling, checklists, and backtesting. And lastly, we're going to look at how to avoid common psychological and risk-based mistakes that mostly lead to losses. So this class is going to be very brief. I'm intending to use only 30 minutes of your time. So let's start. So for us to be able to manage risk, we should be able to understand what actually risk management is. So what is risk management? Risk management is the process of identifying, or rather assessing and minimizing potential loss in trading. So number one, it protects capital and ensures long-term survival. So in most cases, or rather in simpler terms, managing risk entails protecting your capital. Remember, when you're undergoing losses, your capital is going down, or rather what you call your margin is going down. So risk management entirely is pegged to the fact that you're protecting your own capital. So what are the key risk management tools? Number one, position sizing. Position sizing. So, and in this we say only risk a small percentage of your capital per trade. What do you mean a small percentage of your capital? This is what we mean. That, for example, if the size of your capital is $100, risk something between 1 to 2%. But this is entirely up to you. You can also risk 10% of your trading account, trading capital. You can risk 20, you can also risk 50%. It solely depends with your risk appetite. But to be safe, 5%, 10%, or 1 to 2% is also a good amount to risk with. Number two, stop loss orders, and this is something that people really ignore, and that is preset level to exit losing trades automatically. So what are we saying? Never ever open a position without a stop loss. A stop loss is not there to stop you out of the market, but rather it's there to stop you out of the market when you're undergoing losses, thus protecting your own capital. So I repeat again, always, every open position that you have, always have a stop loss. Remember, the market is a brutal place. You cannot predict everything in the market. The market might go against you at any given point. So it's good to always have a stop loss to protect your own capital. Number three, and this is also something that traders always ignore, take profits. Take profits. Take profit or profit lock. Lock your profit. Secure your gains regularly, even small ones, so winners don't turn into losers. Is Ambrose in this class? Ambrose, if you're there, kindly mute yourself. Okay, Ambrose is not here. But this, just to explain this, the importance of having a take profit, I will go back to this part right here.
No, I'm here and I'm wondering, have I not muted myself?
No, not that. I just wanted to show this. You'll get why I'm talking about collecting profits. If you can remember.
Yes, yes.
Where's that trade? They've actually been triggered into this, but anyway, this was the trade. This was the vet trade that I had sent into the group. You can see. So what happened, if you can remember this trade thumbs up, I know Ambrose does because he took this trade. If you can remember, yes. So if you see this, you can notice that the market actually came, triggered us in, then immediately it went to almost 50% of our take profit. Remember, our take profit is all the way here. But when it went to 50% of our take profit, I sent a message in the group. Ambrose, remind us what the message was.
Well, I don't, let me check and see.
I said something. Collect what?
Collect profits.
Collect profits and then do what?
Is it adjust your entry level?
To what? Not your entry level.
Your stop loss to the entry level.
Yeah, exactly. So if you did that, actually you underwent profits. Let me just explain it in simpler words. So the market triggered us in at this point, went all the way here, meaning that you are in profits already, around 50%. I remember I exited this trade at 70% or something. 70, and Ambrose was around 89 because his leverage was quite high. So it was 89%, mine was around 70, if I can remember, 70%. So it means I was already 70% up. So what did I do? Lock your profit, then adjust your stop loss to your entry. And what happens when you adjust your stop loss to your entry? Someone has texted that. Friday, tell us. Just tell us what you've texted in the group. When you move your stop loss to your entry, what do we call that? Or rather, what does it mean? Friday. Okay, let's have someone else to tell us what that means. What does that mean when you move your stop loss to your entry?
Well, it means that you have secured, even if, the distance between all the amount that is between the stop loss and the entry is a realized profit, or a locked profit rather.
Okay, let me explain to you in simpler words. Thank you for that, Ambrose. But let me explain in simpler words. So in simpler words is what initially the situation was, if our stop loss was hit, if you can see this, let me try and zoom that. If our stop loss, let's say our risk appetite was, let's say our account is, the way it is to $100 and whatever. So it means that when our stop loss is hit, how many dollars do we lose? We are risking, remember, you are risking only 10%. You can see our risk is 10%. So you are risking 10% of $100. So once our stop loss is hit, how much do we lose? Ambrose?
$10.
$10. But when our take profit is hit, how many profit do we make? You can see it there above.
We are getting 169. Huh?
So minus our capital, which is 100. So how much profit?
$69, 69.85.
Yes, 69.85. So remember, we didn't get to our take profit. So we collected our profit at around that zone. But I also said in the same message, adjust your stop loss to your entry. So if I adjust my stop loss to my entry, let's adjust and see. If I adjust this won't work. But remember, the loss that we are supposed to incur if our stop loss is hit, that's the word. If our stop loss was hit, the loss that we're supposed to incur is $10. But if you adjust our stop loss and to our entry, that means if the market hits our entry, we get stopped out at that juncture. But because we adjusted it to our entry, then we'll exit the market without losing any coin. So in short, no wonder it's called a break even. Friday has just texted that in the group. It's called a break even. You have broken even. You have not undergone any loss because your stop loss was adjusted to your entry. So in short, this downfall, or rather this downtrend, will not affect you. You will have made money from this uptrend right here. And once the market reversed, it will stop you out from your entry zone. So you'll exit the market with that 89% profit in the case of Ambrose and 79% profit in my case. Is that okay now? If you have gotten that concept, thumbs up. Yes, that's basically the analogy of always collect profits. Do not let greed control you and see the bigger picture of how you could make a lot of money. Those small money, secure them. Secure gains regularly, even small ones, so that your winners, remember, if you did not do what I said, your win trade, you'll be up in profit, 89%. But at the end of the day, right now, you'll be actually in losses. You'll be stopped out at this juncture. You'll be up 89%. Within no time, you're out. You're in the negative. You've actually lost that $10 that has been triggered at your stop loss. So secure your profit so that your winners do not turn into losers. Number 3, we discussed this in detail in a previous class, I think we did on Tuesday, which is the risk-reward ratio. Aim for at least, when I say at least, is the least, 1:3 risk-reward ratio, or even above. You can see this trade, the risk-reward ratio was what? 1:6.21. So anything above 1:3 is a good risk-reward ratio. The other point, diversification, very important. Always diversify. By diversification, we mean across assets, sectors and trading styles. In crypto, spread your holdings among multiple coins and categories. And we discussed about this when you're talking about portfolio building. Buy coins in the layer 1 ecosystem, category rather, buy coins in the layer 2 narrative, buy coins in the AI, buy coins in the DeFi, buy coins in the gaming, and all that. Diversify so that if one narrative is affected by maybe bad news or something, you can still, it means now your portfolio is not imbalanced, or rather you're not in big losses, since other narratives will be up there to replace that narrative. Then trend alignment, and in simple terms, by this we say, always trend the trade. Always trade the trend. Yeah, always trade the trend. And by that we mean, if you come to this chart right here, you can see the prevailing market trend is what? The prevailing market trend right now. The prevailing market trend is what? Is it an uptrend? Is it a downtrend? Is it a consolidating market? Someone to tell us.
A downtrend.
A downtrend. Perfect. Yes, it's a downtrend. So when we're saying always trade the trend, we mean in a downtrend, do not come in a downtrend looking for a buy position. Trade the trend. Look for a short position. The inverse is the same. When we're in an uptrend, look for a buy position. Do not look for a sell position. So in the prevailing market trend right now, you're supposed to be looking for a short position unless we get a trend reversal to the uptrend. The other point, use of leverage. Employ sparingly. By sparingly, we mean carefully. Remember, leverage magnifies both your profits, but also it magnifies your losses. And to add on that, it also increases your chances of being liquidated. So use leverage, but use leverage wisely. And by wisely, we did learn a formula of how to calculate the leverage to use while still maintaining your risk appetite. Then fund custody safety. Avoid centralizing all crypto on one exchange or wallet. Use multiple secure platform. But someone, if you're looking to hold a particular coin for a long term, what is the best way to store that crypto? Or which type of wallet is the best to store that crypto? Pius?
Cold wallets.
A cold wallet. Can you give us examples of cold wallets? Just two main types of cold wallets. Or examples, rather.
I'm not sure.
Or companies. I'm the one who is asking wrongly. The companies, any two companies that produce cold wallets. Joseph?
Ledger.
Yes, Ledger. And?
Trezor.
Yes, Trezor. So you can get either from Ledger or the Trezor. If you are looking to hold tokens for a long time, kindly, or if you're holding large amounts of crypto, the safest way to store your crypto is on the cold wallets. Also, this fact that you're talking about, do not keep your coins on one exchange, is because if, for example, your Binance gets hacked, then it means the only amount that you lose, the only crypto that you lose, is the crypto that will be on the Binance exchange, and you'll be secure on other tokens that are on maybe other centralized exchanges like BitGet, Bybit, and everything. Also, you also remember, because these are centralized exchanges, they can go bankrupt any day and they can come trembling down, like the way we had an issue with the FTX. So it's good to diversify your crypto across different centralized exchanges. Then disposable income only, and in this, this is what most people like to call invest what you can afford to lose. Only invest the funds that you can afford to lose. So never risk funds needed for bills or emergencies. Trade only with what you can afford to lose. Lastly, there's something we call the mental readiness. Psychology starts before the trade. Enter the market when calm, focused, and emotional free. And this is because if you're not emotionally free or calm or focused, you'll enter that market diluted. You'll enter that market with greed. You'll enter that market with fear. And remember, fear and greed what fear and greed will do to your analysis is that it will dilute your analysis. You'll be delusional when you're analyzing your chart. So always enter the market when you're calm, focused, and emotional free. So let's look at the 3 most critical risk factors. Number 1, risk capital. Money set aside strictly for trading. Losses won't affect your lifestyle. This is basically what we've said right now. Always risk an amount that you're ready to lose, so that even if you lose that amount, your life will still go on. You'll still be able to pay your rent. You'll still be able to go to school and stuff like that. So always risk the amount that you can afford to lose. Secondly is the risk per trade. We've discussed that already, and you have seen that in this. For example, in this scenario, I was risking $10 to get $62. That's basically it. Risk per trade. Let's look at that. So predefined loss tolerance per trade, or in accordance to your risk appetite of that particular account. Example, you're having a $500 account plus a $10 risk. So what does this mean? For your account to be fully wiped off, you need to lose 50 trades. 50, you can imagine, 50 consecutive trades for you to blow that account. And by blowing, I mean for that $500 to be completely gone, you need to lose 50 tries. Do you think you can lose 50 tries at a go? Someone? Even if you're guessing, do you think you can lose 50 trades at a go? Someone? And to give us a Pius?
Yes.
50 trades at a go, back to back 50 trades at a go.
Yeah.
I don't think so. Back to back. Today you enter the market, a loss. 50 trades, even if you're guessing.
But that will be gambling, because how will you analyze? Because when you've done the analysis of one, the parameters may have changed for the others. So it's not may not be very possible unless you are a team and each person handling maybe 5 trades.
Yes,
team of 10.
Yes, unless you're doing that, I don't think you can lose 50 trades back to back at a go. But anyway, what the advantages of having a small risk appetite is that it is giving you, if you're risking $10 per trade with a $50 account, you are basically having 50 tries for that particular trade. Imagine a scenario where you're risking 50% of this trade. In short, you're risking to $50 per trade. How many trials do you have? You're risking to $50 per trade. How many trials do you think you'll have before blowing that account? Someone? Joseph?
2.
Yes, you're only having 2. So it will only take you two losing trades for you to blow that particular account. And two losing trade is very easy to do that. You can actually have two consecutive trades that are losses. So no wonder you're saying your risks should be reasonable enough so that you may be able to survive, or rather to protect your own capital. So overall exposure, total risk across all open position, keep it within your comfort zone. In short, risk, your risk appetite, it varies between people to person. Someone might risk 1 to 2%, another might risk 10% and all that. So your risk should be in accordance to your risk appetite. So common mistakes that traders do. Number one, and I see this a lot of times, over leveraging. Over leveraging is both a positive thing and also a negative thing, but mostly a negative thing because it's greed. Remember, the higher the leverage you're using, the more money you'll make. But remember, also your chances of being liquidated, or rather losing your money, are very, very high. So number one, over leveraging. Number two, also this is something people tend to ignore a lot, is trading without a stop loss. Trading without a stop loss. It is quite bad to trade without a stop loss. Remember, a stop loss is there to save you, or rather to stop you out from from extensive losses. So always do not ever open a position without a stop loss. Number three, revenge trading after a loss. So you've made a loss in the market. Now you're entering the market with the target of revenging, or rather of recovering the amount that you've lost in your previous trade. Like we say, do not trade when your emotions are high, when your greed is high, when you're fearful. Always enter the market when you're calm. And this is because when your emotions are high, your analysis is always diluted. You'll forget your trading strategy, you'll forget all the rules that you have, and this will lead to more losses. So revenge trading, when you make a loss, close the trade at that point, resume after some few hours after your emotions have died down. Number three, ignoring proper position sizing, and this is self-explanatory. Then number four, centralizing funds in one place. We've looked at that and I've given you the disadvantages of doing so, because you can have a scenario like the FTX exchange where it collapsed. So it's better to diversify your funds across different centralized exchanges, or rather, if you're looking to hold coins for a long time, it's good to invest in a cold wallet. A cold wallet may look very expensive because I think right now it's around 30,000 to 40,000, but it is very, very important to have that ledger, or rather cold wallet. Then failing to lock profits or follow the trend. We've looked at that. By following the trend, we've said if it's an uptrend, trade the uptrend. If it's a downtrend, look for a short position. And also failing to lock profits. I think I've demonstrated that in this example, this live scenario that we actually did this week. So let's look at controlling emotions. Why emotions are dangerous in trading. Number one, you should always know that trading is 80% psychology and 20% strategy. So, like I've said, if you enter the market when you're tensed, or rather when you're fearful, or rather when you are revenge trading, what happens is that your judgment will be clouded, or what I was calling deluded. So, emotion cloud your judgment, they spark panic, and they will trigger impulsive move. And with this, they lead to more and more losses. Then the common emotional traps that exist. Number one, fear. Fear is hesitation. Fear is also fear of missing out. So you are chasing the hype. Then exciting winners too early. Another type of emotional trap is what you call the greed. Greed will bring about what you call overtrading. Greed will bring about what we call ignoring the plan or your strategy. Number three, greed will bring up upping the size recklessly. How do you up your size? Over leveraging. So greed will do that, because remember we said that when you over leverage or using high leverages increases your profits. and greed will bring that. But you should also remember that over leveraging is what? It's also very dangerous because it brings up, or rather it increases your chances of being liquidated. Number 3, hope. Hope is clinging to losers awaiting a reversal. If in case you're trading without a stop loss and now you're in losses, you're clinging to hope that that coin is gonna change its direction and go up, and now you'll be in profits, or rather you'll break even with your losses. So hope will bring about the issue of clinging to losers while awaiting a trend reversal. Number 3 is regret. Regret is an emotion that will lead you to dwell on past mistakes instead of learning. Remember, your mistakes should be journaled somewhere so that you can learn from them. So regret is also a common emotional trap. So tips to control our emotions. Number 1, remember I said you should always have a trading plan. Follow your trading plan without exception. One of my main trading plan is always, I do not follow the hype. And number 2, I always trade what I see in the market. I do not chase the charts. I do not enter the market with the intention of having a position that particular day. So I'll only trade once I see an opportunity has presented itself. It doesn't matter if I only have 2 setups in a week, but that is always my number 1 rule. I'll always trade when I see an opportunity. So I might enter to the markets today, I don't see an opportunity, I'll close that day like that, and I'll resume tomorrow to come and see if an opportunity has been presented. Number 2, use a checklist before each trade to stay focused. A checklist. If, for example, you trade an order block and FVG, have a checklist of your own strategy. Like, I only enter once I see an FVG that has aligned with a bullish order block that has aligned with maybe a trendline liquidity. So always have a checklist. A checklist to use before any trade so that you can stay focused. Number 3, journal every trade. You can have a book where you journal every trade, say why you took this position from this point, but I'll also share a link to a platform known as Notion. Notion is an online journaling platform for traders. You can go there and be journaling there. So journal every trade, record your emotion before and even after. Number 3, take breaks when stressed. Step away if you feel charged. So if you are not feeling okay, if you are not calm, remember you said approach the markets when you're calm so that your emotions are not diluted, they're not clouded, or your judgment are not clouded. So if you feel you're stressed, if you've made a loss and everything, take breaks and step away if you feel charged. Number 3, or rather I've lost count, trade only with the risk capital. And with that we mean trade the amount, or rather risk the amount of money that you can afford to lose. Lastly, cultivate a mindset where desire to succeed outweighs the fear of a loss. And by this we mean, or rather, this is something most people say, that fearful money made no money. So even if you're saying your emotions should not be diluted, or rather you should not fear, remember you said the common emotional trap is fear. Even if you're fearing, remember that feared money made no money. So be ready to risk, always take a risk. And if you're taking proper risk management, you should not be in fear because you're risking a small percentage. Start with even risking only 1% of your account. Then as fear and as your strategy gets into place, you can risk more percentage on the go. Let's look at trading psychology. This is the last thing we'll cover this night. I said we're going to use only 30 minutes. So it's not an intensive class. So lastly, we're going to look at trading psychology. The mindset. What is trading psychology? Trading psychology is the mindset and the mental resilience a trader maintains before, during, and after the market engagement. So mindset and the mental resilience a trader maintains before taking that trade, during and after market engagement. So traits of our successful traders: number 1, discipline. But by discipline, we mean you adhere to your own strategy and not impulses or jumping to the hype or FOMOing or JOMOing. So discipline, adhere to the strategy. Number 2, consistency. Apply the same method through wins and losses. So remember I said there are over 100 chart analysis techniques out there. So we always say learn one and be a master of that one. So apply the same method through wins and losses. Consistency. And there's something I've learned through the gym. Like, consistency is everything in this life. If you want to if you want to lose weight, consistency in the gym. If you want to gain weight, consistency of eating. If you want to build a successful career, consistency. Everything. You cannot avoid consistency. I think consistency even beats talent. You can be very, very talented, but if you're not consistent, then it beats the purpose. So I think consistency is very important, even than talent, or rather being smart. Consistency. Number 3, you have what you call self-awareness. Know your emotional triggers. Be self-aware and know your emotional triggers. Number 3, confidence. And remember, confidence is not something you attain. Confidence is something you build over time. It's something you attain gradually. So build on that process and not ego. And I think confidence, you can also attain it through consistency. If you're consistent in the chart, remember, I always say, you might learn something like you've learned already here at KCM, but the hours you spend on the chart, the better you become at it. So be consistent on the chart, and the better you be consistent on the chart, the more consistent you are at the charts, the better you become, and the more better you become, the more confident you become. And no wonder we are saying confidence is built on the process. Then we have patience and emotional resilience. So wait for quality setups. Like I've said, be very, very patient. Wait for quality setups and bounce back from any setback that you may incur. Lastly, this is the last thing we'll cover. How do we improve our psychology? But mostly, the main important thing we should say, how to improve our psychology, I think is just time in the market. I might teach all this risk management and psychology, but for real, the psychology and the risk appetite, you learn on the markets. Go make a mistake, then you'll one day remember what we learned here in this class. So you'll go decide not to use a stop loss, you learn from that. You go over leverage, encounter a loss, then you learn from that. So I believe psychology is actually learned when you're trading yourself. I might be teaching here, it might not make a lot of sense, but once you start trading on your own, you'll be able to understand what you're talking about when you're talking about psychology and risk management. So how do we then improve our psychology? Number 1, meditation and mindfulness. And that I've just said, to avoid having deluded or clouded judgment, have a calm mind before your trading session. Number 2, routine building. Trade in structured time blocks. If for example you trade the New York time, the Asian time, and all that, maintain that. Or rather, because now you're starting off, you can explore all the trading times. Then after exploring all the trading times, you can then decide, you can now settle down on which trading time best applies to you. Number 3, back testing and demo trading. Before even investing your real amount or your real capital or your real money, first back test. And by back testing, we mean understand a strategy and start applying it on the charts to see if actually you took those trade or you took that live position, if you would have made money or not. So demo trading, demonstration. You are using a demo account to trade. Number 3, we have positive reinforcement, reward a plan adherence regardless of the outcome. Then number 3, reflect and learn, and this is the purpose of having a journal. A journal will be able to help you see where you did your mistakes, and you'll be able to learn from those mistakes. So treat every loss as a lesson and update your plan accordingly. Then avoid the gambler's mindset. Trading is not a lottery. rely on edge and probability, and not luck. So do not go on the markets betting, or rather guessing on position. Oh, let's buy, let's sell. No, trading is not a lottery. Lastly, focus on the process of a profit chasing. Focus on understanding the strategy rather than being greedy in chasing that profit. So the mental edge matters. Amateurs focus on making money. Professionals focus on managing risk. Smart trading isn't about never losing. Remember, you can never win all trades. It's about protecting capital and staying emotionally balanced in the long run. For example, if you see this chart, someone might come to my chart right here and see that I was actually stopped out from this trade. So they may think I made a loss from this trade. But in real sense, what did I do? Collected my profit from this juncture, then, or rather locked my profits from this juncture, then moved my stop loss to what? To my entry, and I had a break even. So in real sense, this was not a loss as it looks right here. It was actually profit. I got out of that market with profits without losing anything. And no wonder we are saying that smart trading is not about never losing. It's about protecting your capital and staying emotionally balanced in the long run. Or rather, this applies more. Professionals focus on managing your risk. I managed my risk, and at the end of the day, even if the market did not go the way I wanted, I still made money on that particular setup. And with that, we come to the end of this class. If you have any question, thumbs up. Any question? Any question? Thomas?
Yeah. Is it possible to quickly highlight risk associated with when you buy a coin and hold? Mm-hmm. And secondly, how can one know when some of those coins are going to go up? Like so that you can be early enough. And some of them, of course, they go up and go down. But in such cases, how do you manage the risks?
Let's do this. I think what you're asking is how to spot good tokens. I think we covered this when you're talking about, I'll give you homework to go and look at crypto fundamentals. Go and look at that class of crypto fundamentals. There we highlighted how to spot good tokens. But also because tomorrow's class is not also as detailed, I can decide to cover that in that. I can add some notes we cover on how to look at good coins. Is that okay? Because tomorrow's class is about crypto careers. I can combine that, crypto careers and how to spot good tokens. Is that okay?
All right, that's okay.
Yes. What was the other question? It was entirely pegged on that.
It answers both.
Oh, okay. Yeah, I'll add that. I'll add that to my notes. Any other question?
Now, the trailing stop loss.
Did you check it? I did not check it. I'll also do that. Then we're going to look at it tomorrow also. Let me even write it down.
All right. Could that not be a very good risk management tool?
I cannot speak on that right now. I'll have to try it. Then I'll tell you tomorrow.
Okay. All right.
Yes. Trailing stop loss and... Thomas, what have you said you're going to do tomorrow? I've just forgotten. Trailing stop loss and what? Or how to spot good tokens?
Spotting good tokens and managing the risks around them.
Okay. If everything we've learned today is clear, thumbs up. Perfect. So I'll end this class at this juncture. We meet tomorrow for careers in crypto and Web3, and also we shall look at how to spot good tokens. Otherwise, guys, have a good night, be blessed, and bye-bye.